Welcome back to episode 9 of Compound Growth.
Yeah, guys, so we have a special guest today, one of my good friends, Brendan O'Toole. Brendan is a mortgage loan officer with Howard Hanna. So, Brendan, tell us a little bit about what you actually do on a daily basis and what that role looks like.
Yeah, well, thanks for having me, Mike and Brody. I appreciate the time.
Yeah.
But yeah, I've been with Howard Hanna since November of 2020. What my role specifically is at Howard Hanna as a loan officer is pretty much helping buyers achieve the, goal of home ownership. What I do is look at their finances to see what they qualify for, what programs, et cetera. Offer pre-approvals, solutions to achieve home ownership, and try to get to the closing table.
That's awesome. Yeah, one of the biggest parts of someone's financial picture is real estate, whether that's a primary residence or even investment property. So it's a big thing that you're a part of in someone's financial picture.
Yeah. Usually that's the biggest expense on a monthly basis that somebody has, at least in their early years, before they would get their mortgage paid off going into retirement. So in our situation, going through financial plans, that's one of the biggest drivers of what their plan actually looks like in the long run.
Absolutely.
Yeah. And one of the reasons we wanted to have Brendan on today is there's some things changing with the interest rate environment. We've got a new Federal Reserve chairman coming in, so that could shake some things up. And really, we just wanted to see, what does the housing market look like right now? How's the supply out there? Is this a buyer's or seller's market? So we just have some questions that we want to get into and get your take on.
Awesome.
So, Brennan, the 30-year fixed rate has gone through a lot of ups and downs, even over the last 5 years, from, right around 2% to right now it's at 6.5%. I think it was close to almost 8% at one point. So how do you see that transferring over to, the buyers? And whenever you're pre-approving them for mortgages and they hear what this rate is, what is their reaction to that?
Yeah, so back in June of 2022, rates did see some fluctuation upwards. Prior to that, in COVID, we were seeing rates around that 2 to 3% mark. Since they did start to tick up, the market has fluctuated tremendously.
Yep.
It doesn't mean it has fully stopped. However, I think it did, push a lot of the markets, especially in the area, toward a seller market. Each year, the spring market, ramps up, and you see a lot of buyers out there to, reaching out to get pre-approved, but then face difficulties potentially finding properties and or winning multiple offer situations.
Yeah.
So at least at this point in time, rates have been around that high 5% range to 6.5%. It has not pushed buyers back too much in this current market. I do think the market has stabilized over the past year from a seller's market to a buyer's market, and kind of normalized, not so much buyer's market, but we still are seeing multiple offer situations out there. I think that's one of the main benefits reaching out to me and discussing the financial plan behind purchasing a home. A lot of people are extremely cautious of what their monthly payment looks like. And
Yeah.
in a lot of cases, sometimes they can be unrealistic. So it's important to go through that pre-approval stage, just so you're not wasting your own time, the agent's time, as well as my time, looking at a certain price range when it should be, higher, and it potentially in some cases could be lower.
Yeah. We do our best in the financial planning aspect to taper those expectations and build something in that's realistic when people are approaching us.
Yeah.
Yeah. And just a side note that you mentioned there, with people getting outbid, that's something that I've seen like a lot lately with just friends of ours that are, in the housing purchasing stage of life, where they are getting outbid. Like they're offering a normal price, and people are coming in with cash. So I feel like it's at that stage right now where it is a seller's market. Maybe it has turned over a little bit, but that's kind of what we're seeing, at least talking to our friends.
Yeah. One of the biggest things that's been going on for the past several months, and it will be interesting to see if it stabilizes, is the war in Iran. And we hear every day about oil prices are up, oil prices are down. And oil prices are one of the bigger items that feed into headline inflation data. So with inflation data coming in hot over the past couple months and forward looking seems to be on the same track. That's pushing these housing rates up. Is that affecting any of the loan products that people are gravitating toward? Are people doing more FHA loans? Do you see a lot of first-time home buyers, and how's that look?
Yeah, so year to date at this point, we have seen quite the amount of fluctuation with rates. At one point, we were down to about 5.875, with the average of about 6.375 at this time. I think it definitely has affected the programs that people look into. However, it's pretty much my job to place them in what might be the most beneficial product. There's still a lot of first-time homebuyer programs out there and buyers. So, for instance, we work with an investor that offers two particular programs, one with a discounted interest rate, which you'll see about 0.75% less than the standard conventional rate out there, as well as down payment assistance. When purchasing a home, there's two major factors. It's your monthly payment that we've talked about, as well as your down payment and closing cost. A lot of people do not realize that on top of your down payment, there are closing costs. And unfortunately, in the state of PA, they can get rather pricey. So there are some different ways to try and combat that. First-time homebuyer down payment assistance could potentially be an option, as well as seller assist. So depending upon, you have to look at the property to see how long it's been on the market. If it's a fresh house, you're more than likely going to want to structure any offer to be the most competitive as possible. However, if it's been on the market for a while, there's potential to, maybe go under the list price or ask for some seller assist and then lower your closing cost.
Okay.
And you mentioned rates earlier this year were lower, maybe like high fives. How do you deal with clients that have come to you earlier in the year and said, okay, I want to get pre-approved, and that's their rate, versus now maybe being at 6.5%? If they didn't find a house from then until now, does that rate change for them? Obviously, because they haven't gotten the mortgage yet. And how are your clients taking that?
Correct, Brody. So until you get a fully executed contract, I'm not able to lock your interest rate in, which is pretty much standard for the industry.
Yeah.
So people that I would have pre-approved earlier this year would then reflect a higher interest rate if they were to go under contract today. In some cases, absolutely, that does push buyers to kind of withhold from making any sort of moves. I think mainly what it affected was my phone getting any sort of calls for refinance business.
Yeah.
Because at that point in time, the loans that I would have closed in that 7% range, I did have a few close in the 8% range. I was getting reached out to refinance. Since they started to tick back up, I have not heard from too many people about options to refinance. So that definitely took a back seat.
Yeah.
However, I still think the buyers, this rate range of the 5.875 to 6.5, I think 7 would, really push the market.
Yeah.
But I think a lot of consumers have digested that interest rate range. So
Yeah.
if someone starts to go look at a car, they don't buy that car that day, what's on their mind from that point forward is purchasing a car. So I think when people start to think about buying homes, getting pre-approved, a little bit of interest fluctuation is not going to change them that much.
Yeah, I agree.
Yeah, that's a good point. Is when someone's set on buying something, it's hard to change their mind, whether it's outside factors regarding the house or the interest rates.
Yeah, unless there's a massive spike, which doesn't happen overnight.
Correct.
I'm right there with you. So on another note, we've seen, as we said, rates are fluctuating so much. And especially, since 2008, that's whenever rates were about the same as they are today, right around 6.5% on the 30-year fixed. So with kind of the lock-in effect where we see these buyers that they currently have a home, a pretty low rate, maybe sitting between 2 to 4%, because they bought between 2008 and 2021 or 2022. Have you seen that they're really holding steady where they're at and just not buying another home because they're locked in at that rate? Or are you seeing a little bit of turnover there, even with where rates are at today?
Absolutely, Brody. I think from the time frame of June 2022 up until I'd say the end of 25, a lot of people would have no interest whatsoever in purchasing a new home because they have that lower interest rate.
Yeah.
However, there's still a lot of people out there that need to upsize, downsize, and or right size.
Yeah.
So I think finally this year I have seen a lot of people, I guess you could say in essence, giving up their current low interest rate. However, their current situation at home, whether they're having more kids or retiring and don't need as big of a house, I think it's finally starting to see some turnover with that. But definitely for a few years there, it pushed people not to make any sort of big transaction.
Yeah, I agree with that because, I mean, in our meetings, we see a lot of clients. Obviously, we're dealing with a lot of retired individuals or going into that stage of retirement. So we see that downsizing effect where it's like, oh, I got this big house, all this property that we bought, 15, 20 years ago. We loved it over that time frame, but now we don't want the upkeep in retirement. We're going to move into a patio home or something a bit smaller where we don't have that kind of upkeep. So we've even seen that in the last year or two.
Too many stairs to walk up and too much grass to cut.
Everything needs to be on the same level.
Yeah.
The washer, dryer, bathroom, same level. So
and what's positive about some of those scenarios is the amount of current equity out there in the market. I mean, it's the highest it's been and ever has been.
Yeah.
So there are some different options when it comes to that. We offer through Howard Hanna, it's called the Buy Before You Sell program. So it's necessarily a bridge loan, and it takes a certain percentage of the current equity in your house to go toward the down payment and closing cost on the purchase of a new house without having to sell your current house.
it's interesting.
So that has definitely been a very popular program
Yeah.
in the past couple of years, just with the amount of equity out there.
So it's almost like a short-term HELOC, home
It
equity
is.
line of credit.
It is correct, because a lot of lenders and banks would not close on a HELOC if they knew that that individual's goal would then go toward purchasing a new home. So the bridge loan, in essence, is a HELOC without,
The title of a HELOC.
the title of HELOC.
That's interesting.
Yeah, that sounds like a good product to have and attract a lot of transactions to come your guys' way.
Yeah.
That's interesting. One of the things that you mentioned is refinancing, and you have the lock-in effect where some people do want to hold steady at those lower rates, and then conversely, you have people that are maybe sticky at higher rates. Back in 2022, they bought a house. I know personally, I bought a home in 2025, and I get 10 phone calls a day soliciting me to refinance my home. What do you see out there in terms of refinancing, and when does it actually make sense to refinance for somebody?
Yeah, good question, Mike. And that's a difficult question just for the reason every situation's different. What I have to do on my end of things is pretty much look into what their monthly payment is at this point in time, rates, escrow as well. A lot of people forget about escrow, what time frame it makes sense to refinance. So it's hard to really determine, is it a 0.5 percentage difference in interest rate? Is it 1%? So every situation is different, and you always have the option to do cash out refinances as well. So there might be situations where you want to consolidate debt. Divorce is always a big thing where it comes into play to refinance. So every situation is different. I'd say at this point in time, rate and term refinances, unless you have, an 8% interest rate or high sevens, I haven't got too many touches with refinances at this point in time, but it doesn't mean it's not a bad idea. So it's always good to get with me, get with a loan officer to run those numbers to see, hey, here's what I could save you, 25 years after refinancing, and it could be, pretty dramatic.
Is there a specific timeline after you buy? Like when you close on a home, you're not going to be looking to refinance 2 months after you close on that home. You're still getting situated and seeing what the market's doing. But is there a specific time where maybe you would want to wait at least 1 year or wait at least 2 years, anything of that nature?
Yeah, normally it's about 8 to 12 months, I would say, to look into that, because you have to remember when you close on a home, you have closing costs. When you refinance, you also have closing costs. You can, however, roll those closing costs into your loan. However, that's just adding to your loan amount at that point,
Yeah.
which is, affecting your loan to value and equity in your house. So, again, it's pretty much, just a case by case basis. But I definitely wouldn't recommend, refinancing directly after closing on a deal.
Yeah, probably not the best idea.
No.
So like we mentioned earlier, purchasing a home's probably the biggest purchase that you ever make in your life. What are some of the mistakes that you see people make whenever they are, making their home purchase or getting a mortgage?
Yeah, good question, Brody. I think a lot of people are very highly strung on certain areas, and it's pretty crazy to think that a lot of people in my industry talk, and I'm sure it's very similar to you guys, that it's like talking in hieroglyphics and it's a different language, which totally makes sense, especially to the first-time home buyer. But I think it's just having the right people to hold your hand throughout the process and learning about it, because it is one of the biggest things that you'll be purchasing in your lifetime. So you have to have the right hands holding you. The other thing too, just number wise, is to always remember the closing cost. I know I keep saying it, but depending upon what areas you're looking to purchase in, can also fluctuate that closing cost, mainly because of taxes. School taxes, particular school districts might fluctuate a higher interest or transfer tax, as well as a thing in the state of Pennsylvania called transfer tax. Depending upon what municipality you purchase in, fluctuates that number. And the reason that it is so important, a lot of municipalities in the Pittsburgh area are a total of 2%, but the buyer and seller split that in half.
Okay.
However, if you're looking to purchase in the city of Pittsburgh, which would include like Highland Park and Shady Side and Lawrenceville, it actually increases up to 5%. And that's based off the purchase price. So again, split that in half, 2.5 each side.
Yeah.
You're looking at $1 million house. That's $25,000 alone in transfer tax. So,
Wow.
the closing costs are a thing. They're not fake, as well as, it can be pretty substantial depending on price range and location you're looking to buy in.
Yeah. Yeah. And I'd say, whenever I purchased my home, obviously I didn't know you at the time, but I think the biggest thing for me at least was just working with people that I trusted, because obviously I'm no mortgage expert. I don't know all the ins and outs. Like I had no idea about that. So it's just working with somebody that is on your side and is going to kind of hold your hand through the process, because it's not something that you do every day if you don't work in the business.
Yeah, for sure.
So it's just having a trusted individual by your side that's going to help you out with every step.
Yeah, fortunately, I did know Brendan when buying my home last year. Talking about down payments when you're buying a house, are there situations where you would recommend somebody putting more than 20% down? I know 20% is pretty standard. Are there scenarios where you would recommend more or less? How much cash somebody has in their checking and saving account? How does that factor in?
Yeah, so I think in certain situations, depending upon where people might want their monthly payment to be at, is potential reasons to increase that down payment. So in certain situations, if people are doing work to the house, they want that emergency cushion. First time home buyers especially, it's something to think about. Do I want $10,000 up front to keep for a rainy day or to do anything to the property, or do I want $60 to $70 less in a monthly payment? And I know you said the standard's normally 20% down, and why a lot of people think that is because that then removes monthly mortgage insurance, which is added into your monthly payment. First-time home buyers are actually able to put as little to 3% down conventional, 3.5% down FHA. A lot of people still do that. And then anywhere from that obviously can increase. But, it's not always that I see 20% down, 20% down, 20% down. That would be pretty much a very qualified buyer. However, a lot of people don't put as much money as they can down just, for
Have some liquidity on the side.
exactly.
Yeah. Yeah.
That's a great rule of thumb for buyers out there to know that, hey, if I'm looking at an extra $10,000 that could be in my bank account or could go to renovations to the home, I'm only going to get a fluctuate of $60 to $70
Yeah.
in the actual monthly payment.
Yeah. Yeah. And that's a conversation that I'm sure you have all the time, that I'm like just talking to my buddies about whenever we're out.
Yep.
Because like I said, I know a lot of people in that stage of life where it's a matter of, hey, here's where I'm at right now. What should I be doing? What sort of costs should I be looking for a home as far as a purchase price goes? And here's what I have. So what do you think I should even put down on it? And my biggest thing is having an emergency fund set aside.
Yeah.
Because like, for instance, whenever I moved into my house, anything that can go wrong will go wrong. I think we did an air conditioner, water heater, dryer, all in like the first maybe month and a half. So we got banged over the head right away. And I'm like, it's a good thing that we had that money set aside to be able to fund those purchases, or else you're just starting out in a hole, which is exactly what we didn't want to do. So yeah, I think that was a really good point that you had of just have some money set aside and factor that into your purchase costs and how much you're going to put down so that you don't start out, already digging yourself a hole.
Yep.
Yeah. One other question that we have is for homeowners out there right now who do have significant equity built up in their home. What are some best practices or what are some options that they have if they have built up a lot of equity and they're potentially looking to make a move or just put themselves in a better financial situation overall?
Yeah, I mean, you could always do a cash out refinance, which would be refinancing your current home for a certain percentage minus any mortgages and or liens on that property. Could give you that equity. If you're purchasing a new home, you could also do a bridge loan that we talked about,
Yeah.
and then a home equity line of credit. So in those three different situations, it's always situation dependent, but pretty much the three options at that point would be cash out refi, home equity line of credit, and a bridge loan if you're going to purchase another house.
Okay.
What are you seeing right now as far as rates on home equity line of credits?
That's a good question, Brody. I don't do too many of them, so
Okay.
it's a tough
Yeah.
question. But they are slightly above, your normal 30-year conventional rate.
Okay.
I don't know if I'd say, 0.5% higher or 0.75, but there is, a little bit of, increased normally because of the risk position.
Yeah.
They're in second lien position because normally you'd already have a first mortgage on the property. You're looking to get a home equity line of credit, which would then be second lien position. Hopefully your first obligation would be your actual mortgage payment. So that's why you see the fluctuation in interest rate at that point.
Yeah, one thing that we see a good bit is that people don't actually know that most home equity lines of credit are variable rates.
Yeah.
So they'll come in with their statement and be wondering how 3 years ago their rate was 5% and now it's at 7.5 or 7.75. And so those do typically tend to be variable interest rates on a home equity line.
Yeah.
Conversely, with a 30-year fixed mortgage, that's always going to stay the same.
Yeah. That circles back to having, the clarity and trusted person on your side that you would expect to, be forefront about that variable rate so that going into it, hey, this might jump up over time.
While we're on that, do you see many people taking on a variable mortgage rate when buying?
So those are actually adjustable rate mortgages, ARM products, and there's, variations of those said products. 5/1 ARMs, meaning for the first 5 years it's fixed. After that, that interest rate can fluctuate every year up until the 30-year amortization. So it's definitely an option for people. It's normally for your more well-qualified buyers because that debt to income ratio changes. just because of that potential fluctuation. But it's hit or miss, I'd say. Some people are interested. It's definitely a risk threshold. It's tough to say with what the current interest rate markets, doing at this point in time that it might make sense for them. But they do normally offer a discounted interest rate. I'd say about, 25 basis points to 50 basis points less. So it could always, be an option for people, but it pretty much is what their risk analysis would be and if it, makes sense to them.
Yeah.
And with where interest rates are at right now, do you see people maybe going to a 15-year fixed rate rather than a 30-year, or what are you seeing more frequent because the 15-year rates are lower, correct?
Correct.
Yeah.
And you guys probably would be able to talk a little bit more in depth about this, but a lot of people think that the federal funds rate is what fluctuates mortgage interest rates. It's not a direct reflection. There might be some correlation, but mortgage interest rates are mainly based off of your bond market, which is where you guys might be able to step in a little more here.
10-year treasury, correct?
Correct. So the 10-year treasury is what the 30-year fixed mortgage rate is mainly focused on. Since that bond market has gotten a little closer with the different levels, 2, 5, 10, the difference with the 15-year compared to a 30-year isn't as dramatic.
Yeah.
It does reflect a lower score or a lower interest rate. So there are some people, older individuals might be more interested in 15 years. They don't want to stretch that.
Yeah.
Amortization over 30 years. But the other thing to think about is you also don't want to put yourself in a situation just because you want that house paid off in 15 years, because you could always make an additional payments per year, which could then cut a 30-year, loan into 24, 25-year loan, and then so on and so forth. So just because you can or want to pay that property off in 15 years, you could also reflect a lower monthly payment, across 30 years, pay more toward that monthly, toward that balance with an additional 1 or 2 payments a year and still see, 24, 25-year loan.
Yeah. We get that question a pretty fair amount with people who have lower interest rate mortgages and they have some extra monthly cash flow and they're asking us, hey, should I put an extra $500 or $1,000 on my mortgage every month because I got this extra money? Or even, a more extreme example, should I pull money out of my investment accounts to pay off this mortgage? And the question is really what is your interest rate? Because if your interest rate is 2% and you can get a 5% bond, or you can be in a high yield investment account that's earning 6, 7, 8, 9%, why would you take your money out of that and pay off something that you're only paying 2% on? Now, if that interest rate is substantially higher, maybe 7 or 8%, more similar to maybe an auto loan, that's when, I would maybe start having the conversation of paying off the debt sooner.
Yeah. Yeah, I completely agree with that. We see it all the time. But yeah, it's really just looking at the interest rates and comparing, okay, if we look back and your investment accounts have averaged this much, obviously that's no indication of what it's going to do in the future. But you can see that, hey, your mortgage is only X amount, 3%, 3.5%, and maybe you've averaged 7.5 to 8%. Doesn't make sense to take from this bucket to add to the 3% that you're paying right now. So
yeah. That's where I push those questions to you guys.
That's whenever we get a call from our clients saying, hey, can we go hop on a 3-way call with my mortgage broker? We got to talk about paying this off or not.
Yeah. Well, Brent, what other advice do you have for home buyers or sellers out there? General advice, any tips or tricks of the trade that you know?
Yeah, I think one of the last things I want to touch upon is what's called your debt to income ratio. It's one of the main things that I look at to qualify individuals to purchase a home. Your credit score is one thing, but the debt to income is the main thing as well. And what that is, it takes a look at your gross monthly income, not your net. It takes all your current monthly debt payments, whether they're student loans, credit cards, car payments. It adds the new proposed monthly mortgage payment and then divides that by your gross monthly income. That gives me a percentage that different loan programs have a limit to work up to. On average, it's about 50% debt to income as your ceiling.
Okay.
However, if you think about it, 50% of your debt versus your gross income, which we both know you don't take home or that gets direct deposited, could be a pretty high number to, purchase a property at.
Yeah.
Not saying you do not qualify for it, but it's something to just keep in mind. Do I want to be house poor and, go to that 50% debt to income limit? Or is it, smarter for me to look at a, lesser purchase price or put more money down to be able to, live more cautiously while you purchase a home?
Yeah,
that's
just because you are approved doesn't mean you have to go get that.
Exactly.
You have to spend that much. So
Yeah.
that's a really good point.
A lot of people do indicate a specific percentage of their income that they think should go to their mortgage, but it's an interesting point that you make. It's not just your mortgage payment, it's your global monthly liabilities, not just the mortgage that you're factoring into that debt to income ratio.
Yep.
Yep.
Well, guys, we want to give a big thank you to Brendan O'Toole over here. Shared some great insights with us. I definitely learned a few things. Bren, is there anything that you want to plug for yourself or your company, and where can people find you if they're interested?
Well, I appreciate both your time this morning, Brody and Mike. It's been a pleasure. You can follow me at O'Toole_Brendan Instagram, and my number is 412-584-9055. If you want to give me a call, anything mortgage related. Thank you.
All right. Tune in next time for the next episode of Compound Growth.
Thanks, guys.
Thank you.